Today's trading tip is on news events. Now, if you have been just recently got introduced in the market, or you've probably been a trader that has experienced a lot of bulls and bear markets in your past lifetime, you would have probably been looking at these recent news events and noticing how the market is reacting to this so much more drastic than it has ever been before. And what do I mean by this is there are certain days in the market life cycle. So, say for example, a Tuesday of the month where the CPI readings or the news comes out, or there is the job numbers, and these are all market I would say market manipulators or market trigger points. Trigger points is the right word. So these trigger points will cause the market to change direction. So positive or negative, depending on what these numbers are. And there's a lot of these indicators. And the best way, and my advice to you, is to, in the background, while you trade, while you learn how to trade, just keep any of your favorite news channels on. If you have access to CNBC, or you have access to Bloomberg, or whatever is your local news channel or news outlet, keep that on in the background, and it would give you access to when is the next latest news event. Another news event would be the earnings results. So this is again a really big indicator, and this would actually cause the markets to react, or stocks to react. So this is more for stocks. But if there is a lot of the stocks, or maybe say just like one stock in a sector comes out negative, it can drive the entire sector down, or the fleet or the flock of stocks that are very closely related to that sector down as well. So these are just some examples. There are a lot more like different types of indicators. The one of the crucial indicators is the interest rates that come out, and it could be called different names in your region or your location where you are right now, but these are still news indicators. And another way to keep an eye out on this is through these calendars. If you have access to any trading platform, you would have access to news event calendars, or you could just look into sites such as investor.com, or any of your favorite sites. They would have a news calendar there, which would tell you when exactly in the cycle this particular event's coming up. So that's just kind of like priming into what this is all about. So we know that these news events are coming out at these certain times. Say this is on a Tuesday, so these, some of these come like once a month, some of these come every quarter. Earnings is on a quarterly basis. The CPI comes out every on a monthly basis, like on a Tuesday or a Thursday. It changes. So like these are the different indicators. Now the important thing to do is try to avoid trading around these indicators or these news announcements. And the reason for it is, now say for example you are trading a particular chart pattern, and say for example the simple pattern would be say a moving average crossover. So you have these crossover points, and you'll say you have another crossover point like that, and your style is to buy and sell like when the two moving averages cross each other, or you're using the RSI indicator, which is actually, this is the mean, and then this is going up, and this is going down, and this is your RSI indicator. Now, whatever your charting style or your trading strategy is, these indicators tend to be bypassed. And I'm writing bypass really big because it's an important word in this. These indicators tend to be bypassed in what the market is thinking about. So the market news, or the fear, or the positive excitement in the market is so much that the market just like forgets that, oh, I actually have the 200 period moving average that I need to focus on, or I need to look at the MACD levels have actually now crossed each other. So these are important indicators. However, there are times where these indicators are bypassed and the market then just goes like, wild. And this word wild is actually, an appropriate word because the market just like kind of like does whatever it feels like in the direction and the momentum that the market is taking or the news is taking it into. And sometimes it could just like flip flop. It could be positive in the first 5 minutes and then again turn down. And you probably would be smiling when you hear this because you've experienced that real time. Now, it may not be so much on the daily time frame, but the daily it may look like something like just like this. This would be a candle. It'd be a candle like this, and although it's actually traveled so much, but on the intraday it would be something like this. So, and then it would kind of like settle down here, and that's how the candle is formed. So this is not a basic candlestick lesson, but just giving you the concept of like how would the market react to it. So while moves are expected, and there are a few things based on my study, based on my analysis, what I would recommend that you do in these cases. So the first thing that you could do is keep an eye out on the next moving average line. So just say you're trading moving averages and or supports and resistances. Now, if the market just goes wild and has, you've been paying close attention to, say, a strong like level of resistance there, so it's just crossed it. Now, the next thing to keep in mind is what's the next level of resistance. So if it's here, the market may just touch it and then again go down, or it may just kind of find its next ground there. So the important thing to do in these circumstances is, though the market has not paid attention to the current support and resistance or the current moving averages, it will in most cases pay attention to the next technical indicator. And it does that because the market needs to rest on something, or once it kind of like gets back to its senses, it needs to now decide on what's the best strategy forward. Like, what could I do now to navigate myself in the market? And what it does is that it will find the next technical support, next technical resistance, or the next. So if it breaks through the the 50-day moving average and it's going in the upward direction, the next one would be the 20-day. So it may take support on the 20-day moving average, or if it's going down from the 50-day, and it would then take support on the 200-day moving average line. Or if it doesn't do that and you're trading on the daily time frame, the next place that you would look at is on the weekly time frame. So my idea or my concept here is pay attention to either the larger time frame, because that's where the market's now treading into, or pay attention to the next moving average or the next support, whatever is your strategy. So RSIs and stochastic MACDs, I would not call them as true indicators, because those are just giving you values of overbought, oversold, and it could hover around those levels for a long period of time. So I hope this was helpful. To recap what I'm trying to talk to you about or explain in this video is pay attention to these earnings. If these earnings ever happen and you're aware of it, try not to get into it before, or if you have a position, get out of the position before these results come out, because the market can be volatile unless you are an insider or unless you know more than the general market. And in that case, yes, do stay in if your intuition or the market sentiment is pointing that it's going to go down. Now, there are times where the market may just start declining the day before, which could be a sign that, okay, there is some weakness there. But however, there are times where the market news comes out better than expected and the market just rebounds and goes to a new high. So these are different circumstances and instances where the market can react differently than you'd expect. So the best advice that I could give you is to stay away while that happens. And once you know what the news is, then get into the market. That's my recommendation. And the reason for that is, so say for example, the market is here right now, the earnings results come out, uh, and the earnings are, say they were expecting say a 2% growth, and it actually turned out to be a 3%. And this is not usually how it is. They would have it as a 2.1 million is the estimate, and the actuals of the what came out was actually 3.1 million. Just an example. Now, if it had to come up at as 1.5, you would see the market just tank down. You don't want to get into that. So the better way to do it is actually it comes out to 3.5, then you go in and then place your buy. What will happen is then now the market just doesn't end its rally in a day. It'll actually then use this positive news because it comes out every quarter. So since it comes out every quarter, you have now the next quarter before you would actually see a decline there. And these moves last a lot longer. However, if the market was less than expected, so say the market showed up at 1%, okay, just say, this would have tanked down, and then you would have to try to recover from this with a stop loss, and you'd like try to get out. So another way that you could trade this would be, if you see it going negative, you would put a sell, and this is actually a short sell. And sorry about my messiness. I do apologize. I need to get better. But it's just me trying a different concept to show this information to you. You could then short sell it here and then get a good downward gain as the market heads lower as well. So different strategies, but this is not a strategy video. This is just a concept to educate you on when is the best time to get in and what are these earnings and why is it important to stay away from it. So again, I hope this was helpful. Do let me know in the comments if you've actually had experiences with earnings, with the CPI numbers, with job numbers. How did you actually strategize it? And maybe share it with this community so that we can all learn and grow with you. And with that, I wish you all the very best in your trading journey. Stay successful and stay mindful of your trading practices. And I wish you a lot of success.